Advantages and disadvantages of IPO for companies are enhancing company exposure and brand image. Going public significantly increases a company's visibility in the media and among the general public. The IPO process itself attracts extensive media coverage, from the announcement of the offering to the listing day. This exposure not only raises awareness of the company's products or services but also helps in building a strong brand image. Investors, customers, and business partners are more likely to trust a publicly traded company, as it is subject to stricter regulatory oversight and transparency requirements. This enhanced brand image can have a direct positive impact on business operations. For consumer-facing companies, increased brand recognition often leads to higher sales. Customers may be more inclined to choose products or services from a well-known, publicly listed company, perceiving them as more reliable and trustworthy. For B2B companies, a strong brand image can help in winning contracts with larger clients, as these clients often prefer to work with established and reputable partners. Moreover, being a public company can attract top talent. Talented professionals are more likely to be drawn to companies with a strong market presence and growth prospects, as they offer better career development opportunities and potentially more attractive compensation packages, including stock options. This influx of talent can further drive innovation and business growth, providing a reference standard for company valuation. When a company's shares are traded on a public market, it establishes a transparent and fair market price. This price is determined by the interaction of supply and demand, reflecting investors' collective assessment of the company's current performance, future prospects, industry trends, and overall economic conditions. Having a market-determined valuation is invaluable for various purposes. For the company itself, it provides a clear benchmark for measuring its value. This can be useful in strategic decision-making, such as mergers and acquisitions when considering acquiring another company. The public valuation of the acquiring company can be used as a reference in negotiating the terms of the deal. Similarly, if the company is considering being acquired, its market capitalization serves as a starting point for discussions. For investors, both existing and potential, the market price provides a basis for evaluating the investment. They can compare the company's valuation with its peers in the industry to assess whether the stock is undervalued or overvalued. Analysts and financial institutions also rely on the market price to issue research reports and investment recommendations, which further influence investor sentiment and trading activity, improving liquidity and attracting more investors. Publicly traded shares are much more liquid than those of private companies. They can be bought and sold on stock exchanges with relative ease, allowing investors to enter or exit their positions quickly. This liquidity is a major attraction for a wide range of investors, including institutional investors such as mutual funds, pension funds, and hedge funds. Institutional investors typically have large amounts of capital to invest and often prefer to invest in liquid assets. The ability to trade shares freely ensures that they can adjust their portfolios as needed without facing significant obstacles. This influx of institutional investment not only provides additional capital to the company but also brings greater stability to the stock price, as institutional investors tend to have longer investment horizons and are less likely to engage in short-term speculative trading. Increased liquidity also benefits the company's existing shareholders, such as founders, early investors, and employees who hold stock options. They can sell their shares on the public market to realize their gains, providing them with a means to diversify their wealth or fund other ventures. This liquidity event can be a powerful incentive for early stakeholders who have invested their time and money in the company's growth.